Okay, good evening everybody, and welcome to the final lecture of Building a Business 2017. I hope you've all enjoyed the series so far. For those of you who have attended 5 of the 6 lectures and filled out the feedback forms each week, just to let you know, we'll be sending out the certificates via email early next week, so you'll receive those then. Miranda, as she's done every week, will be sending you the feedback form during this lecture, which will also include the links to the previous weeks if you haven't managed to fill those in yet, so it will give you another chance to do that. Before we start, I just wanted to make you aware of a couple of opportunities that you might have seen behind me that we've got coming up for the rest of this term and next term. Firstly, this week we have announced the date for our annual conference, the Oxford Saïd Entrepreneurship Forum, which you'll hear as OSEF. This will be held on the 3rd of March next year. So last year, the keynote speakers included Biz Stone, co-founder of Twitter, as well as Will Dean, who is the co-founder or founder of Tough Mudder. So if you want to receive regular updates about this year's lineup and be the first to know about the tickets going on sale, you can register your interest now on our website. So please do that if you are interested to come. Secondly, our skills workshops, which Miranda runs. We have one more this term, which is branding and presentation, and that will be taking place next Thursday, the 30th, at the Oxford Foundry, so you can still register for that. And finally, from me, if you're an Oxford student, member of staff, or alumni, the applications for our VIEW programme have just opened this week for next term. VIEW is a startup programme which involves 6 weekly workshops and a dedicated mentor throughout the process. And the 2 levels are running next term. Level 1, which it focuses on exploring your idea and seeing if there's a feasible market for it. And also level 2, which takes that validated idea and helps turn it into a viable business venture. Applications for both levels are open now. Miranda and I will both be around at the end if you have any questions about any of those programs, so please do come and speak to us. I'll now quickly hand you over to Arbo from the Oxford Seed Fund Committee, who's going to tell you a bit more about the Oxford Seed Fund and how you can be involved with that. Yes.
Hi all, good evening. Thanks all for being here. And on top of all the formidable resources that Katie just mentioned, we have also the Seed Fund, which is basically a student-led fund. We're just taking over from the previous year team. And if you see, it's intended to invest and support students' ideas and early startups. So it's intended to all Oxford students, alumni, or staff. We're building a startup and looking for their first investment or their first significant investment. So what we offer, as we say, is access. Saïd Business School resources, and of course, linked to entrepreneurs, accelerators, incubators. Venture capital funds, capital, as we say, and a portfolio of companies which has demonstrated growth and potential to scale. So, for example, our previous companies has grown 10 to 100 times in scale, with our investment horizon. So we're going to be here doing our networking event. It's me, Charlotte so far, but other people from the team is going to be here doing a networking event. Please, if you have time, come up and chat with us if you have questions. Otherwise, we have also our contacts, and first round is opening soon, in mid-December. Thank you. Thanks, Katie.
So it's now my pleasure to introduce to you Eileen Modral. Eileen is an investment network manager at Oxford Investment Opportunity Network. So she has a huge amount of insight when it comes to your options for seeking investment. So welcome, Eileen, and I hope you enjoy the final lecture.
Well, good evening, and it's a real pleasure for me to be here, and hopefully you find it useful for you afterwards. Now, I usually tend to wander around, but I haven't got anything to hang this on, so I'll probably stay around here. If I wander off and you can't hear me, do pull me back. I also get very excited, particularly around early stage investments. I'm very passionate about it. So if you need to actually put your hand up because I've gabbled a bit or you haven't understood what I said, quite happy for you to stop me halfway through because I don't want to go off on a tangent or anything. So very briefly about me, Onion has been going now for over 20 years. It was set up originally by Sir Martin and Lady Audrey Wood and the Oxford Trust, and it's where we've spun out of. And as you can see, Enterprise Europe Network doesn't say anything at all about Onion. That's a service that I also work on. It comes under Innovate UK programme. You've probably heard of the knowledge transfer networks and the catapults. Well, EEN is one of the services. My part on that is access to finance, and it's to help companies go global. So I mentor, I support, I help them with grants, try and find partners for them. But it sits very nicely alongside the Onion Network, which is a group of active angels. I think this financial year, our angels have put in probably around just under £1 million of investment into companies. And alongside that, we have set up now an evergreen SEIS EIS fund. It will be interesting to see tomorrow in the budget what actually is going to happen about that. But again, well over £1 million that we've invested. That is usually from investors that are the passive investors looking for the tax breaks. So that's me partly in a nutshell. And hopefully what I'm going to be doing today is under the 6th one. I think you've had 5 that's gone through marketing, the value proposition, the business model canvas, etc. You're building your baby up, and then what are you going to do to it? You're actually having to then try and raise funding. So you'll come out to people like me or the seed fund to actually raise your investment. So what I'm trying to do is give a very quick canter around. Whoops, sorry. I've gone very far forward there. Understanding types of finance. And the major thing here is around risk and reward, and particularly for angel investors. The stages and the times that you actually go out to raise investment. It will be a long stretch of milestones where you've actually de-risked your business and your rewards are going up. And finally, at the end there, I will hopefully give you a kind of few tips on what investors are looking for and what does investment readiness really mean. For you, the entrepreneur, it really is, the further you go with the money, the more you have the company that you own at the end. And it really, really is important to be guided by that. That doesn't mean to say that you don't take investment. What it means is that the investments you do take, you make the most of it. You wring the most out of it, and you get the most value from it. Value in this instance does mean risk. The lower the risk, the more value in the business. The more value in the business, the greater value you have in the company at the end of it, and the more that you can keep. The balance for you really is around taking too much or too little any one time. Back in the bubble day when, 2000, 2002, the previous bubble time, companies were raising millions in the tech stage. Some of them didn't even have a full working idea, but everybody was throwing money at them. They didn't know what to do with it. So for you, taking the right money at the right time to take out the risk and build up the business is really quite important. And you will again be increasing the value of the company as you go around. What you have to also ensure, and I think your last workshop was around the finances, that is the really important part on about making sure that the capital supports that business plan that you've set up and actually gets the company to the next stage of investment. So make sure that investment and the raise that you're making fits in line with your business plan. And again, I keep repeating it, takes the risk out of a business. You've actually hit milestones and you've actually built more value into the business. So really what it is, your company's technology really must be aligned to the roadmap and the needs of the capital. And the needs of the capital is really about making the specific accomplishments that you've actually identified over the next 3 to 5 years within your business plan. and it actually reduces the overall risk within that business. Now, types of funding. It really is quite simple. There's only 3 types of funding. They come in various guises, and over the years they've changed. They might have had new names or whatever, but it's basically grants, equity, or debt. You as I'm hoping, very early stage startup, you will take as much advantage of the grants that are out there. Where they come from and how you deal with them is also something that you need to think about, particularly if it's non-competitive grants, which will actually, usually the smaller amounts, anything under 100, will fit in with the de minimis. And if you are then looking to raise an SEIS round, it actually comes off that top value. I can give you more detail maybe later on or outside about the SEIS if you need to know, if you want to know more about it. But just be aware, you can't have your cake and eat it. HMRC wants its pound of flesh. So for a company raising 150, if you've got some grants, which of say 25, 50, that will come off that total. So you won't have a full amount for any investor coming in that wants to invest under SEIS. The equity, owner-managers, management buy-in, management buyout, external investors, that's where my kind of area of interest lies. A mezzanine, which you've probably heard about, it's actually that as a mix of debt and equity. Debt finance, I think for the majority of you here, 5 years down the line, that's probably when you come. If you can't service a debt, there's no point looking for it. Although what you might find is that there are some angels now that are quite, shall we say, creative in how they do and make investments into company. And sometimes they would do convertible loans and so on. And I suppose, in essence, that might be seen as some kind of debt. I've got a number of these slides. This is the funding escalator. So it's pictorial. They're saying something similar, but hopefully in a different way. And very often what you need to be aware of is what you're talking about. I often have companies come through and say, oh, we're raising a seed round. And the seed round to them actually means a VC £1 million A round. A seed round for another company might mean they're actually just raising their first £50,000 grant. So make sure you're talking the same language when you're out there talking to angels and investors. Funding Escalator is really what it's about. And you see pre-revenue and post-revenue. The further and higher up you get on that escalator, the much easier it is to get money. You've actually de-risked it more. Your VCs will start coming in. You'll often have, if you go too early to VCs, if they like it, they can quite easily say, look good, come back in a couple of years, or come back in 6 months when you've started getting sales. They might well track it, but going to the right investor at the right time really is quite important. Grants. Have any of you here already looked at grants and how to go about them? Grants are really useful, but they can be a distraction. For the university here, it's a great way of them developing and getting some of the technology, some of the research out of the lab. But for you as a startup company, very often we find, 5 years later, companies are still chasing grants. They never mature enough. It's always after the next grant. They're very general and usually around a specific purpose. If you look, the slides will be available that apply for innovation funding. Innovate UK, which is the funding partner, have actually made it much more simpler for you to actually go and research what grants are, where they're coming from, whether they're national grants, whether they're regional grants, whether they're local grants. The link should go through to it. But one thing that you might want to look at is the SBRI grant format. That's the Small Business Research Institute. they actually set out for challenges. So I'm sure that what you've had under the business model canvas, the value proposition is, etc. What's the pain? What's the gain? What is the solution you have? Well, the SBRI already has problems, and so it might well be looking at that because you might have the solution for it. So it might well be a shortcut for you to actually get grant funding into the business. They are very bureaucratic. And invariably, anything over 100, usually it's not 100%. You have to still find investment alongside it. So it might be 70% grant, 30% that you have to find. And you actually have to report on them. And very often those grants are only paid after the fact. So don't think you'll get a grant in immediately and then you can start building. You have to factor into that into your business plan, your cash flow, when that money might well be coming in, particularly if you're actually going out to raise, to bring new people in to help with the research. This is from the company's perspective and where I'm trying to find where the risk is. And as you can see, right at the very start, there is an awful lot of risk within there. The concept, that's where you go out and get your friends, families. I know they call them fools, but actually it's usually people that know. Invariably, investors are investing in people, and it's the people that know you are more likely to invest in you in the first instance. As you go higher up in the investments and you start then getting sales, as you can see, the risk comes down. Venture capital, there's usually 2 inflection points where VCs will come in, specifically where they actually have, it's not so linear as that going up. Very often it goes up to a curve, you plateau off and you need a next round of investment, particularly under technology companies. That's very often when a new VC will come in with bigger pockets, deeper pockets. There are also some new or newer VCs that will come in taking a higher risk for companies. You'll have the true VC, which is investing anything 2 million, 10 million, much deeper pockets. But there are a number of VCs that might put $250,000, $500,000 into a business, but it's still quite a long way around over that curve when they will come in. And then very often it's taking a punt on them. They get to know the companies, they get to know the other investors, particularly angel investors in there. Very often those funds are not necessarily from third parties. They will have maybe a third or half of that investment come from private equity, etc. But the other part is coming through from the British Business Bank. So their risk is sits at a higher level than very often a number of the VCs do. This fits in around your value proposition and your business model canvas. What type of firm you are, what's the requirement, what's the need. The difference is around product services. You know, a technology firm will actually have a much deeper curve. It's not a true curve. This is just visualizing. Don't expect to see. Some might be higher up, some might be lower down, some might be further across. It's just to make a point here. You know, even if you're a service company, if you're actually shipping stuff out, do you have to bring them in? Will you have an overhead on your balance sheet where you've got stock to ship out? Are you using a third party? Actually, are you a technology company that actually needs to go through certain stages? What's the requirement on that? If you've got a product, are you going to have it shipped over and built out in China or you know, Eastern Europe or whatever? All that will have an impact and a factor on what type of investment you need, where you need it, and the amount of how deeper pockets you're going to, and actually what the once you've got the risk out, just how big an upturn there's going to be within the business. And this is the final one of them. You see, they're all very similar escalators. The thing is with entrepreneurs, they actually do underestimate just how many players there are and different types there are, and very often they will overlap. Understanding the landscape, lean cost, startup, self-funding, bootstrapping, Very often you will come across there where they come through from the accelerators, and the incubators now fit really nicely into that. But go out, research, find out what's out there. Find out what new is in the market. Different points of your business cycle will mean that you can go to different types of investment and funders as you go along. But we will go through some of these as we go forward, but in general, that's the type of investment that you'll get at a certain stage of the business. And it's also worth knowing that there are some particular issues around particular companies. I'm assuming most of you here are setting up your own business outside of what you're doing within the university. So you're not going to be a biotech company or a drugs discovery company. You'll leave that within your work within the university. But web service, even those will have very specific constraints on them and where you can go and get funding. Right, pre-seed. Very early stage investments, bootstrapping, friends, family, government loans. Where you get your funding from, and if you're a startup, my daughter was a creative. She decided she wanted to go and open up a casting studio up in London. She has the contacts there. What she set up, she had about 100,000. She got a loan, £25,000 loan that she was paying back. She's a service. As soon as she gets in, people start paying. That is not a high growth company, but it's going to make a huge impact. And a number of your companies, hopefully, will also have that. You don't have to be a multi-billion pound company with, turnover of, and gross margins that are really up in the stratosphere, or that you have to have employees of about 100 or whatever. The backbone of any country, and particularly here in the UK, are the SMEs. And it's, small companies that actually will have a bigger impact. So don't think you have to take huge amounts of money. Really, what you're setting up is your vision going forward, making sure that it will have impact on you and you're actually going to increase the value, but you're actually going to make money out of it yourselves as well. There are very often both accelerators and incubators are really a great place to start a business. I think the Foundry now has just opened, and has anybody been to the Foundry or using the Foundry and all its... yeah. Incubators have been around for much longer, and although the shared goals of them is actually in theory to help you as a startup business avoid the pitfalls and the mistakes others have made. So actually letting you leapfrog over those kind of points. And very often these two types of organisations they're very often conflated. However, accelerators are a really slightly different grouping to what the incubators are. And the services that they provide, etc., is completely different as well. There are a number of them out there, as you can see. This was the latest information from Bayes. So 205 incubators, 163 accelerators. Majority of those accelerators are actually around London, whereas the incubators are spread more evenly around the UK. What is it they provide? Incubation, it's an open-ended duration normally. They usually ask for fees and they will ask for rent. So as a startup, you have to factor that into your business plan as well. When do you move out? Oxford Innovation has 24 innovation centres across the country, but it helps companies move out of the back bedroom to be a proper business. But it is a commercial model, and it's expected that the companies will pay to actually be in there and pay for services. Services include things like mentorship, entrepreneurs training, but as you hear and as you know from here, there is so much free support. Take that where you can. but make sure it's aligned with what you're doing. And actually, the people that you're getting it from are aligned with what you're looking for as well. And very often, like investors who are looking for the team, can they work with them? You need to make sure that you choose your mentors wisely as well. There is a selection process going into the incubator, but it's not really that much of an onerous process. For the accelerators, it really is. Most accelerators now provide more than just bringing in a space for you. There's usually a program. It can be anything from a few weeks up to about a year. Two of our companies that we've invested in under our fund, our SEIS fund, one of them went to the John Lewis Incubator. The services they were providing actually is a solution to one of their problems. They were in this incubator, I think it was a 4-week program, and at the end of it, they've come out with sales. And for most of you as know, the real purpose of any business is actually where you're going to make your sales. Another one of our companies was a technology business, and it was headhunted. Rotterdam, the port of Rotterdam, set up its own incubator, and they were asked if they would actually pitch to go out there. There's legislation coming out about emissions on shipping, and that's what their solution is. They went out there, and they've met now over 200 companies. The top 20 are feeders for the others, but again, it's about getting sales. So it opens up. So if an accelerator is something that works for you, do go out, do choose the right ones, do chase them, do make sure that your business plan works for them. And as I say, you can get far more out of them. Right, early stage, very early stage funding options. There are a number of them, but we can't do anything without going through from the crowdfunding. Crowdfunding has made a huge impact on businesses. But again, make sure that you go to the right funders at the right time with the right story. For very early stage, reward-based crowdfunding actually is a great way for a marketing tool. If you can't sell on a crowdfunding with a reward for your business, nobody wants to buy it, then probably you've got the wrong product. The equity-based crowdfunding sites, a number of them, again, they're very generalist, Crowdcube, etc. Very often you'll see those companies that have made it on there are very often local. They might be brewers, etc. They do make bigger investments in one or two, but it is only in one or two companies. And the way that they operate as well, some of these you have to pay to get on the platform. You actually have to have at least 30% of that investment raised already, because if you're down lower in the pecking order, it's around the crowd, the excitement of the crowd. So if you're too low down, you might never make it. So go again to these crowdfunders when you've at least raised part of your funding, if that's the route that you want to take. Peer-to-peer lending actually is a much bigger and much broader reach for early stage companies. But again, you need to actually be able to service that. But there's far more investment going in into peer-to-peer lending than there is actually in the crowdfunding site. There are new ones coming on. There's new methodologies, how they work, how they operate. There are some really interesting ones coming in. There's one that came in from Spain that now looks at life science type businesses, and their model is really around helping and supporting companies. So, as I say, this was a very brief picture of what's out there. It's changing all the time. Do your research. Go out and find what's out there and what's best for you. On to equity. That's where I sit. And it's around the sale of shares within your business. Don't think of it about giving up part of your business. When you've de-risked it and taken it as far as you can, and you then need to take equity into your business, you're bringing in people who will actually share your vision. So make sure you go out. Just because someone wants to invest in you, it might not well be the right investor. It has to be so that both parties actually feel that they can work. I've seen companies just disappear because of the conflict of the investors. They weren't aligned and they were being pulled in different ways. So really make sure that when you go out, don't take money just because it's offered. Make sure that you can work with those people. Equity investment is about high growth. It really is. What is high growth? The main points there are really about the theoretical points. The minor ones is really what it means in practice. And further on, I hopefully will put in around what you've been doing over these past 5 weeks. But think of this around what the business plan is, you know, the presence of the market, why people will buy, product, what solves a problem, bigger, better, faster, quicker, whatever. A defensible market position. A lot of the spin-outs from the universities, etc., they do have IP. But as you as a startup, it's not necessarily the reason why you would why would you go for it? If you've got first mover advantage or if you've got know-how, taking on the costs of IP puts another burden onto your business as well. So if you don't need it, don't take it. A committed management team. At this very early stage, it's really around about you. How far can you go? You don't know everything, but when you're starting your business, you have to be able to turn your hand at most things. But when you raise investment, potentially that investor will have skills, a deep pockets, but a little black book that actually can also help you. But again, the underlying potential there of the significant returns, and that's really about profitability, your exit potential, and an investor coming in will want to know where the exit is. So what are the features of angels? It is their own money. It's usually less formal agreement. Different angels will have different backgrounds, different knowledge, so they actually will be asking different questions of you. Angels will accept far more risk than what VCs are, and very often it might well be around tax breaks. They can be quite difficult to find. There is also less capital. From our angels, some of them will invest in a portfolio maybe of about 10 companies, but they only put 5-10K in and they will do follow-on. Others might invest 50 or more, and we do have some investors, angel investors, that will put anything up to $250,000 and then do make follow-on. Very invariably, those type will actually want to take up a whole round and don't want other angels within it. So you have to be very sure that it's the right angel for you if you've only got one angel. What's the type of VC? It's the reverse practically of it. In majority of them are far more generalists. Their funds are usually more general. They are very good at building value within a business. And I remember talking to a VC once saying, yes, do you look for the A team, but maybe a B company? And they said, no, we always look for the A company because we can always replace a B team. So it's not always the way, but just very often they will look at it a different way. They do have deeper pockets, and they really are paid there to make it. They have to make investments. But from a VC's perspective, a fund might well be a 10-year fund. So they bring the money in the first years. The first 4 years they're investing. Over the next few years, they're doing follow-on investments. And for the final few years, they're actually looking for exits. And so going to the right VC at the right time might be that they're at the back end of their fund, so might not be making new investments into it. This is just more or less the same one, but actually trying so you can see who to go to, where to go to, and where they're opposing, but what's the skill set they actually bring into it. And again, 3 principles. It's about value. All investors want to get their money back, the same as a company. They're aligned. All investors need to get a return on their investment. and all investors want to get a return on that investment that's proportionate to the risk that's involved. And that comes back to that theme, risk and reward. And for an early stage business, the risk is much higher and the rewards are much higher. Very often VCs are agnostic within specific sectors. They are less risk-taking. And often they will only make 2 or 3 investments in a year. So going to the right ones at the right time, again, I can't say more than keep repeating, is really, really important for you. So 3 steps from your perspective. Determine the risk that's addressed by the money to be raised, and you will work that out within your business plan as you go through. And for me as an investor, when I'm looking at a company, I want to see the cash flow. Where's the money coming from? What's it going to do? How far is it going to take you? What actually is that milestone that it's come through to? And VCs are exactly the same. They might well say, right, we'll put 2 million into this business, but we'll give you first this amount at this valuation, and then we will hit that milestone, and then we'll put more money in. Nobody's going to give you the full amount, usually right at the very beginning. And there I said it, the V word, valuation. That is so much a bone of contention between companies. You always want to value your business far higher than what you think. I had a company come through last week I was talking to. He has an MVP, minimal viable product. He is selling up to large corporates, and if he gets a couple of sales in, yes, he might make $250,000 per sale, but he's valuing his business at 10 million, and he hasn't even made his first sale yet. He's also thinking that when he gets his money, and he was looking to raise $1 million, that he was actually going to start paying himself 100,000. If you look at it from perspective, particularly of an angel, why are they going to put money into the business to pay a founder, take their money out? They're putting their money into the business to help build it alongside you. So think of it on that perspective. I will cover debt as well. I think probably for a number of you, it will be quite a long way off. It does take a long time to raise investment as well. When I take and talk to companies, very often they say, well, we need the money like next week. It's going to take 3, 4, 6 months to actually raise investment. And I will cover this point a bit later on as well. But the thing about debt and the thing about equity or money in equity is owned by the business. Debt, the money in the business, is owed by the company. And the one thing from debt, where it's banks, etc., it has priority over the equity. So that's why they are very low risk takers. Any bank will say, and they will put money into a bank where they know it can service it, and if they can't, and if they go bust, they have first priority or any liquidation. So relationship between risk and investment companies. So again, I will say you're increasing the share price. You're reducing the amount the company must sell to raise the capital for each round. So really, the smaller amounts you can raise to actually get the furthest along and take the risk, the better it is for you. And alongside that, you actually are increasing the share of the company and owned by the founders and those that are actually working within it. You all have a multiple of different types of risks that you have to take out. But from the point of view of the investor, the risk is that there's no yield or return on their investment. So let's come for what investors are looking for. At an early stage, it really is about people. It's always about the people, the management team. Can you deliver? How can you work and add value, and with whom they can work and add value? The business, it's around, yes, the business is important. What is innovative about it? Does it have a sound economic business model? How are you going to make money? Is there scalability within it? And really around the deal round as well. is that well thought through? So when they look at business plans, I see hundreds of business plans all the time. You get a feeling about it, but understanding where it is and where you're going is really important to be able to put the clarity within that as well. Don't be too much technical jargon. Yes, you get hooked up in that and round about what it is, but the technology is not. It's where it's going to make money. Where are you going to scale it up? So what do you need to do? Really is about research. Use networks. Also think about the pressures that any investor is making. As I said, with a VC, are they investing? Do they need to invest? Have they just recently raised their a fund? If they recently raised a fund, they're looking for quality business they can invest in, which they can get a quick exit from. But you will have to have, usually, VCs we work with, they won't even look at a company unless it's actually got £1 million turnover. So we are talking quite late-stage businesses. But it's also for you to actually, it's a two-way thing, you know, look at their credentials. Does it fit with you? Does their ethics work with you? Do you think you're actually going to be able to work with them? What do they want from you? Actually, within your, what you're doing, always think what that angel can bring to the party for you. What is it, not just about the money that they want from you, what else can they bring? Be upfront about it. With the right investor, you know, it will work for you. And what do they want from that investment? Do the research, and very often it's open there. LinkedIn, Google, whatever. Most people are very open. There's a lot of information out there. So actually doing the research is very easy and simple nowadays. So, types of VCs. This is on doing your research. Very few VCs are actually invest in a particular sector. Most of them are agnostic. But very often they will invest with other investors. So when you're doing your research, see who's actually recently invested, who they've invested alongside, those investments they've invested alongside. Is it a particular round, a particular technology? Who else is in their portfolio? All this stuff is very easily found. Make sure that you actually don't do a blanket email to everyone saying, oh, I'm raising investment, I want some. Make it very, very targeted. Make sure that they know that you understand what they're looking for and you've got what they're looking for. Actually, that sort of warm, fuzzy part of it is really quite important as well. Don't think just really on the hard-nosed investors. They're not. Just quickly go through. But if you don't get investment, what does it mean? I love this quote. You know, if you experience difficulty, thing is, it's not particularly because it might not be that they don't like it. It's possibly that it's as they say, crap. Guy Kozlowski was actually, it's very, very true. And both of them are your fault. So if you're not giving the right message out, if you're not talking the right language, don't blame it on others. Revisit what you're doing. Revisit your business plan. Find out, actually, am I doing this wrong? And what about that business plan? What is a business plan? It really is a really important document. I was doing a workshop a few weeks back. In fact, it was a couple of months back. And there was someone in the audience who'd just come back. He said, I've just come back from America. The new thing from America is now you don't need a business plan. I don't know if he meant you don't need any business plan. Nowadays, very often, I will get a pitch deck which substitutes as an exec summary, which substitutes as a business plan. It doesn't matter, but really it's important to lay out what it is you want to do. It is around the statement of intent. It's a shopping list, and it's a shopping list for you inside. And if you look around the value proposition, it actually should then what resources you know. And I think the business model canvas actually chimes with this, so actually helps build out your business, your business plan. It actually also helps give clarity of thought for you, putting it down, laying it out, looking at it, revisit it on a continual basis as well, because things change. And very often, don't be so fixated on your business of what you're looking to do that you don't see what might else also be out there. There very often is low-hanging fruit, that if you take advantage of those things that come up and take it, that to me is really far better for an entrepreneur and shows a better entrepreneur than someone that's so focused that he can't see and actually listen to what other people are saying to him. We had a company that raised its first investment of 200,000 about 8 years ago from us. 5 years back, it raised further investment, but it's a really strong technology one. What it is, it's about glucose within the eye, and it measures thickness, steps, etc. He was at a trade show, and he had Rolls-Royce come up and saying, "Oh, your system there, actually, it might be a solution to us." It went, and it wasn't the whole of it. He had the technology and he licensed it out to them. And he has £1 million turnover on that side issue. What he's now found out, he's still focused on what he wants to do and the ambition that he had. But what he's seen is there are other opportunities there for his business. And part of the technology that he's using is actually going to be used as a diagnostic. So where he was actually looking, his main focus was really about making sure that people with diabetes didn't have to keep pricking their finger. They could actually measure it through the eye thickness. He's gone off to Rolls-Royce, where actually they're measuring thickness on their big engines, and he's actually going into a diagnostic tool. So as entrepreneurs, look at the business plan, but look outside of what you're doing, listen to people, and very often, if there are opportunities there that you think might fit with you, go off and do them. Don't ignore them, because actually it might be the way you get first sales, or might find new investors, or might find an exit for the business. So, have you all heard of the KISS method on the business plan? It's about keep it simple and stupid. Most of your business plan, when you're sending it out, they don't need to know about the technology. It's about show me the money, and that's really what you need to do. And you will find different investors will want different things, but all around is around the market and the opportunity. And it's set around how much, for whom, for what, for how, for whom. And a lot of the business plan is really for your purpose. If you originally go out initially to investors, they're not expecting to find a 35-page business. They're looking for an exec summary. And for me, I only ever read that first paragraph of it. And it really is important for equity investors, that first 1, 2, 3 page, an outstanding executive summary, which summarizes everything that's in your business plan. It's around the solution to the problem that you think your business is actually enabling. The market, the competitor analysis, yes, partly within that, but a lot of that can go into the appendices. You don't get points for the actual weight of it. It's actually the content that actually people are looking for. So think of the start of the business plan around your elevator pitch. And I can't go on, we have talking about debt. When you go to a bank, they don't like risk, they don't like surprises. What they're looking for in the main is all about the finances. So by the time you come to be a business which actually has sales and growth, by then you should hopefully have employed a financial or a finance person who actually can do all of this. If you're not a finance background, that's what the banks are looking for. Really detailed plans, no surprises in it. Show where you're actually going to service it. And that business plan is really also quite important. If you gave... Oh, hang on. Blank screen. The elevator test. The Camelot and the kitchen table. If you gave your business plan to an individual, would that individual being able to go up, if he was really excited about it, and the right investor, would he actually be able to go up in an elevator and actually tell somebody else what your vision is, what it is that you do? Or would it be completely blank because he hasn't understand most of the jargon within it? And the kitchen table test is really about, can someone sit down with their partner and tell them exactly what they're going to spend their hard-earned cash on and investing into a business? And finally, the Camelot test. There are 25 nights around the table. If you give your business plan to that one first night, will he be able to explain to the next one? And by the time it comes to the 24th night, would they be the same story? Or actually, will that night then actually turn to the next one and actually give something about a business that he actually heard of, not yours, because he just didn't understand it? Executive summary again, really, really, really important to get it out. And as I say, I look at usually the first paragraph, and the first thing I look for is how much are they raising? Does it fit within my criteria? Does it fit within my investors? Does it fit within our fund? And so actually understanding what it is you're doing. Oh gosh, I think that's the television telling me it's finished. Think about the journalist, really who, what, where, why, how, all in that first impact. It's around backing the team, not around the market. What's the need for the investors? And as you can see there, from a VC's perspective, that actually is data that's put out by Innovate UK. Most VCs will see 25 to about 100 proposals a month. About 6 to 15, and I think pushing it at 15, actually might get a meeting. But actually, the only investment is between 0.5 and 2% will actually get investments. So it really is a low percentage that will get investment. For angels, it's probably a slightly higher percentage. But again, they will see far more companies. So actually being able to engage and get it exactly to the right investors with the right message really is important. And it's all around financing the bottom line. You won't get money just because you need it and just because you think it's important. You have to persuade others that it's really important. You've got the next best thing since sliced bread. Are you credit worthy? Are you investment ready? Are you commercially viable? You know, where's your product? Really about the finances. You know, if you haven't got sales, where are the revenues? Cash is really best, but actually, what are your projections? And actually being able to project when your first sales come in, where they're going to do, the trajectory of them is really, really important. But the need for money really doesn't mean to say you're investment ready. Being investment ready is taking your business to the point as far as you can to actually then you need that next investment and maybe an angel investor or a VC to come in and help take you to the next point. And finally, tips about funding. It is always more difficult to get funding when you actually really need it. So really plan ahead. As I said earlier, it can take 4 to 6 months really to raise investment. We have a company that hopefully will be closing a £2 million round. It's been closing that round since May early this year, and still they're actually in 12 weeks now of due diligence, and hopefully at the end of it, that VC will invest in the company. Work out how much and what sort of funding you will require, and that comes back, is it going to be grants? Is it going to be equity? If it's debt, as I say, there are small firms loan guarantees. So if you're a very small business that you're going to hopefully maybe provide a service, get 5 people in, if you're getting a service so you're actually selling it quite quickly, the small firm's loan guarantee can give you up to 25,000, which is a big impact on a startup company. So there are loans out there specifically for companies. Innovate UK currently have got a new loan scheme to actually help scale up. And that sits, they can't, there has to be a problem in the market. They can't compete with the market out there. They're not trying to replace it, they're trying to support it. And these loans fit in very nicely with those companies that might have got research and development grants. They're now in the development stage, and potentially these loans will sit alongside it. And it's very, very patient money, and it's at very competitive terms. They're expecting to get, wait over 10 years to get their money out. So if you're a business that's looking to scale up, there are other ways of getting grants and debt funding out there. But always make sure you provide them with the right information and what they're looking for. Don't send out a full 30-page business plan. Actually, a lot of that business plan might well be really important. And if you're sending it out to angels, you're giving away too much information, because they might be investing, or they might have invested in a company that's a potential competitor to you. So really make sure what you send out is limited, and build up that relationship, build it up, find out if it's the right one, start sending out further information as you go. And I think on that point, probably overrun a bit, but I'm open for questions. Thank you very much. Are there any questions? Ask me anything. You're very quiet. I either covered everything, or I've completely, you've misunderstood everything I've said. Hopefully it's the former.
Thank you very much for the very useful talk, and you summarized very well what the investors are looking for. But you ended with rather difficult one when you say don't give too much to the investors at the beginning. So how do you strike the balance in terms of which you try actually to sell your idea and convince them, and at the same time you're not giving too much? It's a very difficult balance to make.
When I help companies do their pitch, very often as a company, you know too much. You go all the technical, you're really passionate about it, you want to just go all the information. What you need to do is distill it down to actually what is the essence of that business. What's the pain, what's the gain? And that's where very often that value proposition comes in. And actually, even a technology one, I have companies that might be the next drug that's going to cure cancer. But actually it's getting the audience nodding, even it's an individual or a whole group. So actually being able to distill, actually saying, nowadays people are dying from cancer. Well, I've got a drug that actually is going to enable breast cancer to be cured. Those in the audience can understand that. If it fits with what they're wanting to invest in, fits within there, or it might be their Aunt Flo died of cancer, they'll come up and talk to you. So that way you're starting to get that connection with them. That's really what it's about. You build the relationship. Does that make sense to you?
Okay, if there's no more questions. Oh, there are.
Oh,
there are more questions.
What's bootstrapping? What's bootstrapping?
It means if you're starting business, you're actually putting your own money in it. You're going, it's very lean. You're not going outside for any investment. We have 3 angel networks under ours. Onion has been going the longest, tends to be something with a strong barrier to entry, precision engineering, medtech, platform technologies. Our TVIM one tends to be those that have got first mover advantage, tends to be companies that have got first sales and looking for scale up. But the Oxford Early Investments, which sits under that, actually is a feeder for the other 2. It sits under our SEIS fund, but it's very limited number of businesses that come through. Those companies that come through the OEI network are looking for more than just investment. Those companies that have bootstrapped actually will leapfrog OEI. They will start looking for the later stage investments. So bootstrapping really is about you as an individual taking your business with as little as funding as possible to a point where you actually then start needing investment. That's bootstrapping.
I think because we've reached just gone 7 now, I think Eileen will be staying around for a while for
Yeah.
the drinks reception. So if you do have any questions, please catch her outside. I just want to say a huge thanks to Eileen for coming to the centre. If we can